Banks play a silent but powerful role in shaping everyday life in the United States. Most people never see how these systems work, yet their impact is felt every single month when rent is due. Interest rates, decided behind closed doors by banks and financial institutions, quietly control how expensive it is to live, where people can afford to stay, and whether families can build a stable future. For millions of Americans, these invisible decisions have turned housing from a basic human need into a constant struggle. Rent keeps rising, salaries remain mostly unchanged, and people are left wondering how hard work alone is no longer enough to survive. To understand this crisis, we must first understand what interest rates really are. Interest rates are the price people pay to borrow money. When interest rates are low, borrowing feels easy and affordable. People can buy homes, start businesses, and invest in their future. But when interest rates rise, borrowing becomes expensive. Monthly payments increase, loans shrink, and financial pressure grows instantly. While interest rates may sound like numbers on a screen, in reality, they determine whether a family owns a home or rents forever. Banks are not charities. They are profit-driven businesses. Their main source of income is interest. Every mortgage, every loan, every credit line generates money for banks. When interest rates rise, banks earn more profit from the same amount of money. This means that even during difficult economic times, banks can continue growing while ordinary people fall behind. This imbalance creates a system where financial institutions remain strong while households struggle to breathe under rising costs. In the United States, the Federal Reserve plays a major role in controlling interest rates. The Federal Reserve raises rates to control inflation and slow down spending. While this may stabilize the economy on paper, the real-world consequences are harsh. As soon as interest rates rise, mortgage rates jump, business loans become expensive, and construction slows down. Housing becomes harder to afford almost overnight. What starts as a policy decision quickly turns into a nationwide housing problem. For home buyers, rising interest rates are devastating. A home that once seemed affordable suddenly slips out of reach. Monthly mortgage payments rise so high that even middle-class families fail loan qualification tests. People who did everything right, went to school, worked stable jobs, saved money, are told they cannot afford a home. As buying becomes impossible, these families are forced back into the rental market. This shift has a powerful effect. When fewer people can buy homes, more people compete for rentals. Demand in the rental market explodes. Landlords understand this reality very well. They know renters have limited options and nowhere else to go. As a result, rent prices increase confidently year after year. Banks do not raise rent directly, but by making homeownership unreachable, they indirectly push millions into permanent renting. In the past, during years of low interest rates, banks offered extremely cheap loans, especially to large investors and corporations. These investors borrowed massive amounts of money and bought thousands of homes across America. Because loans were cheap, risk felt low. Real estate became a game for the wealthy. Entire neighborhoods were transformed into investment portfolios. While ordinary families struggled to buy one home, corporations bought hundreds. When interest rates later increased, individual buyers were pushed out of the market. But corporations were already protected. Many had locked in low interest rates earlier. They owned the homes, controlled the supply, and could raise rent without fear. This is how housing power quietly shifted from families to corporations through banking policies and interest rates. High interest rates also slow down construction. Builders rely on loans to construct apartments and homes. When borrowing becomes expensive, many projects are canceled or delayed. Fewer homes are built. The housing shortage grows worse. With limited supply and high demand, rent climbs even higher. This shortage is not accidental. It is a direct result of expensive money.
Banks also prefer lending to large corporations rather than individuals. Corporations are considered safer borrowers. This means big investors easily receive loans, while average families struggle with paperwork, high requirements, and rejection letters. This unequal access to money allows corporations to dominate housing markets while ordinary people remain renters. Another painful reality is that salaries do not rise with interest rates. While mortgage rates and rents can increase rapidly, wages move slowly. Employers rarely increase pay at the same speed as inflation or borrowing costs. This creates a dangerous gap between income and expenses. People earn almost the same, but life keeps getting more expensive. Over time, savings disappear, debt grows, and financial stress becomes permanent. Landlords also use interest rates as an excuse to raise rent. Higher interest means higher costs for loans, insurance, property taxes, and maintenance. Instead of absorbing these costs, landlords pass them directly to renters. Rent inflation becomes a chain reaction triggered by banking decisions. Renters absorb the shock every time. The emotional cost of this system is enormous. People live in constant fear of rent increases. Families delay having children. Couples delay marriage. Parents worry about eviction. Some young adults live with roommates well into their 30s. Some move back with parents. Some live in cars. Banks may see percentages and profit margins, but families feel anxiety, exhaustion, and hopelessness. Over time, high interest rates cause a massive transfer of wealth. Renters pay more every month, but gain nothing in return. Banks collect interest, investors collect rent. Wealth moves upward. The middle and lower classes fall further behind. Home ownership, once the foundation of the American dream, becomes unreachable for future generations. If interest rates remain high, the future will be even harder. Renting may become permanent rather than temporary. Communities will weaken. Financial inequality will deepen. Entire generations may grow up without ever owning a home. Banks will remain powerful, but society will pay the price. Banks and interest rates may seem invisible, but they are among the strongest forces shaping modern American life. They decide who builds wealth and who struggles to survive. Until this system changes, rent will continue rising, salaries will lag behind, and the housing crisis will only grow deeper. The question is no longer why rent is high, but how long people can survive under a system that rewards profit over people.